could have the same sort of volatility in silver. I mean, silver could shoot up quite easily. And Mike Oliver, who's a technical analyst I certainly respect, thinks that it could go to $300 by the middle of this year. China is the second largest miner. To even import silver doré from Mexico, EV production going off the charts. In China, I mean, it's killing people like Tesla, I understand. Silver was going to explode. And what is China doing? Are the authorities supplying silver into the vaults? No, they're not. They're just standing back. Watch out if you hold SLV.
Until the gold to silver ratio gets down below 30 to 1, maybe even more preferably 20 to 1, that they won't even begin to consider selling their silver. Are you viewing the ratio as a sell signal at some point, and what range are you looking for?
Trump, with this tariff, China had to take a number of steps, secured a completely separate payment system from the dollar and SWIFT for international trades. The ability to protect the yuan by tying it to gold. Vaults, the SGE, the Shanghai Gold Exchange, have opened vaults in Saudi Arabia and also Hong Kong.
Physical silver shortages are seemingly pretty severe. There's virtually no meaningful physical silver available for large buyers. Refineries, they're backed up, they're prioritizing gold, and dealers can't source it at spot prices, so you're left with massive premiums being applied. As a result, what are you expecting to see in the silver market moving forward?
Well, it's a bit of a car crash, isn't it? I think, well, let's just look at the background a little bit. I mean, in the case of silver, there's been a supply deficit compared with demand, supply from the mines and also scrap compared with demand for the last 6 years or so. And something eventually had to give, and that's now what's happening. I mean, again, we come back to China. China is the second largest miner. It even imports silver doré from Mexico to refine. And where does the silver go? It doesn't go back to Mexico. So there's that. And also they import other ores, silver-bearing ores, copper ore, lead, zinc, whatever.
Spot prices look calm, but physical premiums are screaming stress beneath the surface. As Alasdair Macleod notes, a 6-year structural supply deficit isn't a short squeeze. It's a slow burn imbalance that finally surfaces when inventory buffers vanish. When refiners prioritize gold and large buyers can't source at spot, the disconnect exposes how paper pricing can drift from physical reality. For investors, this isn't about coin shortages. It's about whether commodity ETFs truly reflect underlying supply. If this strain persists, Alasdair Macleod's warning implies pricing power may shift abruptly, and that's where volatility begins.
Something like 60% of silver, mined silver, actually comes as a byproduct of other metals. So, and they're importing this ore and refining it and keeping it. They are the largest processor and miner of silver in the world. I'm talking about a critical mineral. And at the same time, you've got EV production, electronic vehicle production is going off the charts. You've also got, in China, I mean, it's killing people like Tesla, I understand. You've also got photovoltaic cell business and all the rest of it. And India is getting in on that act as well with the big multinationals like Reliance Industries, building huge solar production facilities and solar generation farms. So silver was going to explode. And what is China doing? I mean, it's interesting watching what's going on in the Shanghai markets, both the gold exchange and the futures exchange. Are the authorities supplying silver into the vaults? No, they're not. They're just standing back. They're letting the market sort it out.
When 60% of silver supply depends on base metal mining, output can't simply ramp because prices rise. Alasdair Macleod highlights that byproduct dependence limits elasticity, especially while EV and solar demand accelerate, two sectors projected to grow double digits annually through 2030. If China dominates refining and withholds incremental supply, it gains pricing leverage across global clean energy chains. For equity investors, that means margin pressure for Western manufacturers already battling higher capital costs post-2022 Fed tightening. And as Alasdair Macleod implies, if Shanghai lets price discovery run freely, the next move may reshape industrial cost structures worldwide.
Which is fascinating because in the past, they have suppressed the price of silver. They have kept control over the price of silver until it finally sort of went through the window in the second half of last year. So this is, I think, is a very, very important development. Now, where does silver go? I mean, there is no doubt that in both COMEX and also in the London forward market, there are paper claims considerably in excess of the availability of silver. And those claims are being called in now. So that's a problem. We had an instant, I think it was on something like the 7th of October last year, in the London market, whereby the lease rate suddenly spiked up to well over 30% because silver was being called in and out of maturing forward contracts. And there just wasn't the silver there. So I think everybody, who's got these liabilities in the paper market, basically are trying to beg, borrow, and steal silver from wherever they can. So I'm not making any accusations, but watch out if you hold SLV.
A 30% lease rate spike is not noise, it's a liquidity alarm bell. As Alasdair Macleod points out, when paper claims exceed deliverable metal, the system relies on confidence, not inventory. October's stress event suggests counterparties tested that confidence, forcing scrambling behind the scenes. For investors holding commodity ETFs or futures exposure, the key risk isn't price. It's settlement mechanics if delivery demand rises. History shows derivatives unwind fast when collateral thins. And if Alasdair Macleod is right about paper leverage, the next disruption could ripple far beyond silver.
I think that this is interesting, and the price of silver, the spot price, and also the futures price on COMEX has been consistently below the price in Shanghai. Now, you can see that there's a lot of speculation going on in Shanghai. Yeah, sure. I mean, the Chinese are wild punters. They love it. Anything leverage they play. So much so. But the interesting thing is that you had this guy, was it Bain Shiling?
Yeah, the billionaire.
Yeah, with over 30,000 contracts short. He accumulated this short position, as I understand it, through January, probably starting slightly earlier. And he's now been stopped from dealing effectively. I mean, he can close the shorts, but he can't buy any more. So there's a huge, great bear squeeze in the offing there. And I see also that the Shanghai Futures Exchange issued a notice today, having identified, I think, something like 150 malpractices, spoofing and acting in concert and, all the sort of various ways in which you can rig a market. And they're acting on it.
When one exchange trades at a persistent premium to another, capital usually flows, unless structural barriers exist. Alasdair Macleod underscores that Shanghai's higher pricing challenges COMEX's dominance in global price discovery. A 30,000 contract short position is not retail speculation. It's systemic exposure, and forced restrictions hint at regulatory intervention. For investors, bear squeezes can distort volatility quickly, as seen in nickel's 2022 LME shock. If enforcement tightens in Shanghai while Western markets lag, Alasdair Macleod suggests pricing power may migrate east, and that changes how commodities are valued globally.
And I sort of think to myself, well, this is actually interesting because we know that the pricing of silver is now really moving to Shanghai, hence the premium there, over the paper markets, which are desperately trying to keep the prices down. But they're also being a lot more responsible than, say, COMEX or the LBMA. The LBMA is basically, doesn't give out information. When it comes to COMEX, you sometimes wonder whether they're doing things properly with position limits, for example, suspending sort of contracts when the price move goes beyond whatever the regulated level is. And you sort of wonder whether they actually care about malpractices and so on. I mean, this is something which is interesting. There's a long history of this. I mean, when you get senior directors on the bullion desk of J.P. Morgan being arrested and sent to jail for spoofing and various other practices, unfair practices in the market. I mean, this is something that COMEX have been turning a blind eye to for an awful long time.
Price discovery quietly shifting from London to Shanghai would be one of the biggest commodity market power changes in decades. As Alasdair Macleod suggests, transparency differences between exchanges matter more than most investors realize, especially after spoofing convictions involving JP Morgan traders in 2020 exposed structural weaknesses. When regulators appear reactive instead of proactive, institutional confidence can erode even if prices remain stable. For portfolio investors, this raises questions about whether Western benchmark pricing still reflects global supply-demand reality. And as Alasdair Macleod implies, credibility, not inventory, may ultimately decide where silver trades next.
All right, let me ask you this. So, you talk about how the paper market is desperately trying to keep the price of silver down. And it doesn't appear that China is trying to keep the price of silver down. They're allowing the market to sort it out. Yep. Being the manufacturing engine of the world, on one hand, you would think that they would want to keep silver down since it's so used and so required in so much of what they're manufacturing. That being said, they have a history of subsidizing their manufacturers or their economy in many ways, but the Western markets don't. And so by allowing the price of silver to continue to go much higher, can you see a scenario where it could really damage Western manufacturing, but at the same time they'll just subsidize?
No, I don't think it's quite as simple as that. I mean, talking about fair practices, just look at the European Union and how they, sort of behave when it comes to product manufactured outside the European Union.
Industrial policy often matters more than commodity prices themselves. Alasdair Macleod hints that subsidies can offset rising input costs, which explains why China may tolerate higher silver prices, while Western manufacturers face margin compression. After the 2022 to 2024 energy price shock in Europe, manufacturing output already showed vulnerability to input cost spikes. If silver behaves similarly, renewable technology supply chains could see profitability diverge across regions. Long-term investors should watch policy responses as closely as metal prices. And as Alasdair Macleod suggests, subsidies, not markets, may determine competitive advantage.
Look at President Trump. We're going to tariff these bastards so that they can't export into the United States. So the pot's calling kettles black here, I think, Gary. I think that's. But seriously about your point, by far the most efficient manufacturers of these industries, which are mandated by Western governments, like we've got to have, non-carbon electricity generation. So it's photovoltaics. It's these damned awful windmill things and all the rest of it. We are passing laws that this is the future. Okay. Now, from that point of view, it's a fairly inflexible market. In terms of demand. I mean, if you get a recession, the demand is not going to drop. That's the point I would like to make. China is by far the most efficient manufacturer of all these products. The people who are going to get killed by it are not the Chinese. They suffer no disadvantage from a rising price of silver. And I think they've worked that out.
Mandated demand changes how commodity cycles behave during recessions. Alasdair Macleod points to government-driven, renewable energy expansion, which makes silver demand less sensitive to economic slowdowns than traditional industrial metals. Policy mandates in the US Inflation Reduction Act and Europe's green energy programs create structural consumption, regardless of GDP cycles. That means miners and material suppliers could gain pricing power even in weak economic conditions. Investors focused only on recession risk may miss this policy-driven demand floor. And as Alasdair Macleod indicates, inflexible demand can reshape commodity volatility in unexpected ways.
That is the point which we've got to understand.
Okay. All right. So a lot of investors, they're taking the perspective that until the gold to silver ratio gets down below 30-1, maybe even more preferably 20-1, that they won't even begin to consider selling their silver. Are you viewing the ratio as a sell signal at some point, and what range are you looking for?
No, I'm not. I mean, one thing at a time. I'm looking at the markets, and I see the sort of short squeeze, which is turning silver into a Giffen good. Now, what that means is that instead of the normal relationship where the price rises to the point where supply is generated to meet the demand, or demand drops off to the supply and there's a price balance. Instead of that, what happens with a Giffen good is that supply just disappears because nobody wants to sell because they can't buy it back.
The gold-silver ratio may matter less during supply stress than investors assume. Alasdair Macleod introduces the idea of silver behaving like a Giffen good, where higher prices actually reduce selling because holders expect replacement costs to rise further. We saw a similar dynamic during the 2021 to 2022 commodity squeeze, when inventories across metals markets fell to multi-year lows. In such conditions, ratios and historical valuation metrics lose predictive power. Portfolio strategy becomes about liquidity risk, not price targets. And as Alasdair Macleod warns, shortages can override traditional market signals.
And this is the whole point. This is what's going on. Now, I don't know how far this could drive it. I mean, we saw a spike in the nickel price a couple of years back, I think it was now. And this again was a big Chinese nickel magnate. He had the stock, but it wasn't in deliverable form. And the LBMA went out and cancelled a lot of the contracts, which created a lot of kerfuffle. I think that we could have the same sort of volatility in silver. I mean, silver could shoot up quite easily. And Mike Oliver, who is a technical analyst I certainly respect, thinks that it could go to $300 by the middle of this year. Yeah. I don't think I'm misquoting him.
No, you're not. I actually had him on a couple of weeks ago.
Yeah. It is, I don't fully understand his method, but from what I've seen of his forecasts, I wouldn't go against what he said.
When a market has to cancel contracts to stop a squeeze, that's not stability, that's fragility. As Alasdair Macleod implies here, the 2022 nickel spike on the LME, where prices briefly surged over 250% in 2 days, exposed how paper positioning can implode when deliverable supply isn't there. If silver faces similar structural tightness, volatility won't be gradual. It will be violent. A $300 call sounds extreme, but when derivatives dwarf physical inventory, price discovery becomes political. Investors need to ask, is the silver market truly liquid or just leveraged? And what Alasdair Macleod suggests next raises deeper questions about whether this is price action or systemic stress revealing itself.
I think he gets it more right than wrong, that's for sure. He's a very good technical analyst.
Yeah.
At the moment, I'm just watching this shortage situation and trying to follow the geopolitics behind it. And I have to say that these two factors look like driving the price of silver measured in our fiat currencies a long way higher. There is another thing which I think very few people really understand, Gary, and that is that you've got to think in terms of pricing things in gold. I mean, the point about gold is that its purchasing power over long periods of time is relatively stable. So when you see a basket of, let's say, base metals go down priced in gold, you know that it should return to that some sort of norm. Now, there are two ways in which that can happen. One way is that gold goes down, measured in, relative to the base metals, or base metals rise relative to gold. With the way fiat currencies are destroying value, their own value, it is clear that this will be reflected in far higher gold prices on any medium-term outlook. Let's just put it that way.
The real chart isn't silver in dollars, it's commodities priced in gold. As Alasdair Macleod stresses, gold's purchasing power has remained remarkably stable over decades, unlike fiat currencies that have lost over 95% of value since 1971. When base metals fall relative to gold, history suggests reversion. Either metals rise or gold falls. But with US debt above 34 trillion and persistent deficits, the probability leans toward higher nominal gold prices, not weaker ones. For investors, this reframes the thesis. It's less about silver speculation and more about currency debasement math. And as Alasdair Macleod hints, the geopolitics behind that currency shift may matter more than any technical breakout.
You remember with all the tariffs on the boards and all that? That was really, I think, what changed China's approach to the dollar. Because until then, it was the Sun Tzu approach of, when the enemy is making the mistakes, don't interrupt him. And that was the overall approach, I think. But Trump with his tariffs was really very, very aggressive. And that meant that China had to take a number of steps. The first one was to secure other markets for their exports. And very, very quickly, the share of China's exports to America has dropped to, I think, a little bit below 10% of the total. So, yeah, that was pretty good. She secured other markets for herself. And, of course, in line with that, she secured a completely separate payment system from the dollar and SWIFT for international trade. And she has put in place the ability to protect the yuan by tying it to gold. This is why vaults, the SGE, the Shanghai Gold Exchange, have opened vaults in Saudi Arabia and also Hong Kong. And Hong Kong, quite clearly from subsequent action, is going to become the international center for China's activities. I think that was always her plan anyway, but this is definitely now coming to the fore. And I mean, if you sort of think back to her gold accumulation plans, which go all the way back to 1983.
Trade wars didn't just shift supply chains. They accelerated monetary realignment. As Alasdair Macleod notes, after the 2018 tariff escalation, China reduced export reliance on the US to under 10%, diversifying aggressively across Asia and the global south. At the same time, Beijing expanded CIPS as an alternative to SWIFT and increased gold accumulation. Official reserves now exceed 2,200 tons, tying yuan credibility to gold while opening SGE vaults in Saudi Arabia signals strategic positioning, not symbolism. For investors, this isn't about politics. It's about long-term currency competition reshaping capital flows. And as Alasdair Macleod implies, the next move may not be loud, but it could be structural.
I mean, they were secret, but, I've got a copy of the original legislation translated into English. So it is actually there. Also, their secret acquisition of silver, which is something that they've been doing for the last 3 decades, to my knowledge. And they've controlled the price. They've stopped controlling the price. They've turned around and said, okay, and, the gloves are off. When it comes to things like rare earths, okay, you've got to come and ask us if you're going to get any of our rare earths. We're not just going to export it. The same with silver, same with tungsten, same with various other critical minerals. And interestingly, silver was put on the critical mineral list by the Americans. Have they got any? No. So this, I think, was a definite plan. Now, given that there is a definite plan, if you like, for the ending of the dollar, I think what's happening is that China is no longer holding back on just standing aside and let the enemy making the mistakes. I think they're now moving into protectionist mode, protecting their own currency.
When a nation stockpiles quietly for 30 years, it's not hedging, it's strategizing. As Alasdair Macleod highlights, China's commodity policy dates back to the 1980s, aligning with decades of gold accumulation and dominance in rare earth processing, now over 60% of global supply. Silver's addition to the US critical minerals list exposes vulnerability, strategic demand without secure domestic production. If price controls are relaxed while exports tighten, volatility becomes leverage. Investors should recognize this as resource nationalism intersecting with currency defense. And if Alasdair Macleod is right, protectionism here isn't temporary. It's monetary positioning in disguise.
Now, part of this has to be, if you like, a very soft attack on the dollar. And I think that this instruction to institutions, who I understand hold roughly half the 680 odd billion dollars of US Treasury debt, the instruction to them to reduce their holdings, I think is a very, very important point. I think it's something we should take very, very seriously. It does mean that it won't be just China. I think there will be other nations that will be divesting themselves of US Treasury debt.
What kind of ramifications are you expecting on the US side of the ledger?
The US have got a problem. I mean, I remember a journalist asking Greenspan the question over China, who I think at that time was the largest holder by far. They asked Greenspan, well, what happens if the Chinese turn sellers? And he turned around and said, well, it's quite simple. We control the register. In other words, they won't be able to sell it.
Treasury markets look deep until major holders quietly step back. As Alasdair Macleod suggests, if institutions controlling roughly half of China's $680 billion in treasuries begin trimming exposure, marginal demand weakens at a time when US deficits exceed $1.5 trillion annually. Yields move on flows, not headlines. Greenspan's past comment about controlling the register reflects confidence in system mechanics, but today's bond market is far larger and more globally intertwined. For investors, sustained foreign selling could pressure yields higher, tightening liquidity across equities and housing simultaneously.